Greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. All right, so what we see here, let me just move this menu out of the way. So what we see here is let me pull up my pointer here. So what we see here is a screenshot, or is a chart of a daily chart of the CBOE volatility index. So the CBOE stands for Chicago Board Options Exchange volatility index. The volatility index is an indicator that measures the expected volatility, the expected movement from the S&P 500 over the next 30 days, right? Over the next 30 days, 1 month. And so in theory, when the volatility index goes above 25, some folks say 30, the S&P 500 is going down in value, and that is interpreted as there's risk in the market. There's fear in the market because the CBOE volatility index is often considered the fear gauge. So when the market is dropping, is going down in value, you'll see the volatility index actually increase in value. So they are negatively correlated. But when the volatility index drops, particularly below 20, the market is considered stable. The sentiment or the interpretation is that the market is very complacent. So right now you can see, as of December the 26th, right, you can see that the closing price, well, not the closing price, well, yeah, the closing price for the CBOE volatility index was 13.6, well below 20. So right now the market is considered to be in a very complacent state. The sentiment is complacency. Now, if we look back earlier this year, back in April, particularly right after the when Donald Trump announced the tariffs, what was that called? Liberation Day. You know, you can see here. Let me just expand the chart a bit more. You can see here on April the 7th, Liberation Day, the market dropped drastically, and as a result, because the CBOE volatility index is negatively correlated to the S&P 500, it actually popped. It jumped up in value significantly to the point where it was at 60 at one point back in April. You know, extremely high. Rarely does the CBOE volatility index get that high. So now, oftentimes, you know, you'll have novice traders, novice investors who will see the volatility index get this high. The market obviously is dropping because they're negatively correlated, and they will use that as a means of selling, right? Because there's fear in the market. When the index or the indicator gets this high, there's extreme fear in the market, and that means that the market is dropping or has dropped significantly. And so this is not the time you want to sell. Actually, this is the time you want to take positions. And for an option seller like myself, the premiums or the amount of money that you can make in a market where the CBOE volatility index is at 60, you can make a lot of money in these kind of market conditions. So we've had a couple of spikes, and this here's a 1-year chart over this year, 2025. But if you look at, so for example, if you look at, I'm looking at this menu here. If you look at this large red candle here, this was back in October the 17th, where we had a spike from the VIX. It jumped up to 28, right? And then we had another spike back in November the 20th, where it also spiked up to 28. But now, right now, the current value of VIX is 13.6. So what does this say? I mean, the fact that the VIX has come down from 28 again, which is relatively high for the VIX, and has come down in such a short period of time. How should one interpret this going forward for the year of 2026? All right, so hopefully you guys can see this this chart quite well, the numbers, but nonetheless, so I just spoke about how we saw the CBOE VIX, or the volatility index, spike above 25, close to 30, back in October and also November. So as it sits now, the volatility index is at 13.6. So that period where it spiked in November, and now just a month later it's below 14, that signifies that right now there's a lot of complacency in the market. But the fact that the VIX dropped below, it dropped from 28 or close to 30 below 14, signifies, according to this research that has come across my desk, that the market is going to do well in 2026, right? So anytime, so this research essentially looked at every time since 1990 where the VIX cycled from above 26. So we saw it above 28, right? But here they're saying above 26 to below 14.5 in a short time frame. So we have seen the VIX go from 28 down below 14 in a short time frame, just within a month, right? So the results are staggering when that happens. When the VIX drops that quickly in a short time frame, 1 month later, the S&P, according to their research, was higher 90% of the time. 6 months later, the S&P 500 was higher 100% of the time, and 1 year later, the S&P 500 was higher 100% of the time. So rarely do you see, research when you're crunching numbers. Rarely do you see a situation that transpires 100% of the time. So I got this from Paradigm Press. Give those guys credit. So it looks like, we're coming to the close of 2025, and just based upon this research, with respect to looking at the volatility index, it looks like 2026 is a time where you want to be long. Now, are we going to have some volatility next year? Absolutely. We're going to be having a new Fed chairman coming in May. So, of course, the interest rate should still continue to be cut. We should still get a decrease in the Federal Reserve interest rate. So yeah, it's that we're going to see some volatility, of course, and you want that because, if the market comes down, that gives you an opportunity to accumulate. So, but it looks like overall, 2026 is going to be a great time for investing in the market.